In September 2019, the invisible plumbing of the global economy broke. Overnight, interest rates in the repo market spiked to 10%, forcing the Federal Reserve to panic print billions just to keep the lights on. Fast forward to today. The media is talking about inflation and stock prices, but they are ignoring the single most dangerous signal in the financial system. The Fed's emergency liquidity tank, the Reverse Repo Facility, has gone from $2.5 trillion to almost zero. The buffer is gone, the plumbing is dry, and history tells us that when this tank hits empty, the system doesn't just slow down, it snaps. To understand why this crash is inevitable, you have to understand the repo market. Think of it as the pawn shop of the global economy. Every night, banks and hedge funds trade trillions of dollars in cash for safe collateral, usually U.S. Treasuries. When the system works, cash flows like water. Banks get the cash they need to operate, and the market stays liquid. But there is a flip side to this. The reverse repo market. This is where big institutions park their excess cash at the Fed overnight. For the last 3 years, this facility has acted like a massive reservoir. It was holding over $2 trillion of excess liquidity. It was our safety net. But while you were watching the S&P 500, someone pulled the plug. Look at this chart. In late 2022, there was $255 trillion sitting in this account. This was the financial grease keeping the system moving. But as the Federal Reserve tightened its grip to fight inflation, that money started leaving the facility. It flowed out to buy treasuries. It flowed out to cover deficits. Throughout 2024 and 2025, this line collapsed. As of this month, we are approaching zero. Why does this matter? Because in 2019, we didn't have this buffer. And the moment reserves got scarce, rates exploded. Today, the Treasury is issuing massive amounts of debt that the market has to absorb. Without the reverse repo facility acting as a cushion, every dollar drained from the system now comes directly out of bank reserves. We are entering the danger zone. With the RRP drained, we are back to a regime of reserve scarcity. The next time there is a shock, maybe a large tax payment date or a sudden sell-off in bonds, there is no slush fund to absorb it. When liquidity dries up, it happens all at once. Algorithms pull their bids, credit freezes. And the stock market, which relies on this easy flow of cash, could face a flash crash scenario worse than 2019. The Fed knows this. That is why they are panicking behind closed doors, talking about slowing down quantitative tightening. They know they are driving a car at 100 miles per hour, and they just ran out of gas. The $2 trillion safety net is gone. The next few months will determine if the plumbing holds or if the pipes burst. We will be tracking the daily liquidity injections right here. If you want to understand exactly how the first crack in the system appeared, you need to watch this video on the 10% spike nobody saw coming. Click here and I'll see you there.